What is the answer to the first question? What should you do? Research expense. So, accounting treatment is what? We should consider as asset or expense? Expense. So, you should debit to profit or loss account as research expense. Credit to cash. Yes, sir, clear?
First one, this loose or what?
Research expense.
Company, get loose?
Yeah, the company is research. But they are incurring some salary for market research. Sending people on the market and asking questions, feeding checklists, questionnaires like this. They are asking how to treat this. What is the accounting treatment for this? Would you get any benefit out of this 20,000 what they spent? No benefit will come. Alas, that has to be written out to profit and loss account. Number 2, 100,000 to purchase a machine to manufacture components for the new car. It has an estimated useful life of 10 years.
So development.
What is this?
Development.
It is not development, it is not research, it is just an asset they purchase.
Yes, capital.
So it's a machine, it's a PPE.
Property plant and
You consider this as an asset and then capitalize according to the standards of IAS. What is standard? Property plant and equipment. IAS
2.
IAS 16. Then you capitalize and then you depreciate. Third one. Is it a research?
Last one?
No, third one.
It's a development, right?
It's a development. Then next question is this meeting all the conditions or not?
So one condition it is.
Do you understand?
No, I understand, but what he asked you to good answer.
Yeah, there are 3 questions. Are you clear that there are 3 questions? Separate?
Third one, I understand this development, right?
Correct.
And the first one,
Research.
research.
See, they use the word here market research.
Okay. Second one,
Second one is a machine. They purchase an asset.
purchase.
An asset.
Yeah, asset.
Hmm.
Asset only.
Yeah, fixed asset.
Fixed asset.
So this will meet one of the 5 conditions.
Yeah, what is the one of the 5 conditions they are talking about? The new
Market
car is
feasibility.
expected to go on sale in 2019. That means there is a market feasibility. They are not talking about other conditions. That means you should make an assumption those are meeting that conditions. Therefore, this is a development expenditure and meeting all the conditions. Hence, you capitalize as development expenditure and to see if we can amortize it or not based on the life of that.
In case if they say the expected selling price is so and so,
Then
you have to take the which is lower.
the cost and then the total cost you have here.
Yeah.
And then if the sales is less than this, then you only take that amount.
Yeah.
Is that clear? Okay, then we move on to the next one. See, they wanted you to show here. So this is another way of telling that 5 conditions. 5 8. probable economic future benefits, intention to complete, availability of adequate technical and financial and other resources, ability to use or sell the intangible asset, the technical feasibility, and it is easy to measure reliability expenditure. Same thing, but they have put it in a slightly different way. So there's a short format, say that, by rate. Anyhow, the development expenditure meets IAS 38 criteria. The required capitalization, the item developed in 2011 and 12 goes on to sale on 11x3. And it will be 3 years from then until any competitor is expected to have a similar product on the market. See, you have research, you have development. So what is the accounting treatment for these two?
P&L.
In the 35,000 in which year's P&L?
2011.
2011 and 38,000?
2015.
2015 and 55,000 and 65,000, they are saying it meets the development expenditure meets the IAS 30 criteria. That means it is development. We should capitalize. And then the next question is from when we should amortize. From the date when it is commercially available to use, you should amortize. How many years? You see here they are saying X1 and X2 goes on sale on 11X3. So X3 is here. So from this date only you should amortize. So it will be 3 years from then until any company. So then our asset will be there. What is this intangible asset is with limited life or unlimited life? Limited life. How many years?
3 years.
3 years. So you have to amortize using 3 years. Understood? So 55 plus 65 comes how much? I think 120. So 40,000 each. Correct? So research expenditure, here first one and here here the last one. Amortization expenditure, X3, X4, X5. Correct?
I understand this one.
You will understand. You know that research expenditure should be written off to profit and loss account.
Yeah.
You understand that? 35,000 incurred in which year?
2011.
2011. So here, expenses 2011, research expenditure how much?
Research expenditure 35,000.
Clear? Everybody clear? And then there is another research expenditure on 2000 X5. 2015, how much? 38,000. So here, under the research expenditure, under X5, you will have 38,000. Is that clear? Now, amortization will begin from which year?
Third year.
Third year means X3. X3, X4, X5. How much? X3 how much?
40,000.
40,000. X4?
40,000.
X5?
40,000.
Alas. Then development expenditure in the balance sheet. X1, do I have development expenditure? Yes.
Yes, 55,000.
I have 55,000. So I will have that. Do I have any amortization in X1?
No.
No. And then when you go to X2, what will be the total development expenditure? 120. Do I have any amortization for X2? No. But when you move to X3, what is the total cost?
120,000.
120. And each, how much is amortization?
40.
So what is the net book value?
80.
That is when? Which year?
Year third.
Then what about year 4?
40.
Cost is how much?
Eight,
Cost is 120 only. accumulated development
Amortization.
expenditure
80,000.
80,000, net book value
40.
40. And the third year, 120 is the cost, 120 is the accumulated depreciation, and the net book value is 0. Anyone want me to do this in the board, or is that okay?
Better if you can please. We'll get more to it.
X1, 2,
This 5 years, huh? 5 years.
yes. Expenses, research. I think here, first year how much is
35,000.
35,000. Here 30.
8,000.
8,000. Nothing here, nothing here, nothing. That's clear, no? Development expenditure, nothing here, but these 3 years. Is that clear? This is P&L. Exact. Now, statement of financial position. X1, X2, X3, X4 and X5.
Manish,
Development.
Mr. Muhammad, from what is 40/40?
Hala?
Aye.
Shoot. What is the total of these two?
120.
20. And they are saying here that it goes on sale on 1/1/X3, and it will be 3 years from then until any competitor expected to have a similar product on the market. So total development expenditure for you 120, and that could be there in my market for how many years?
3 years.
So 1 year how much?
40. Okay.
So that is actually 120 divided by
3.
So development expenditure, cost 55,000 in the first year, amortization 0, so net book value 55,000. 120,000 the total, no amortization, so 120,000. 120,000 is the cost, amortization 40,000, net book value 80. 120 is the cost.
What here second year is 65.
Pardon?
Yeah, but add 55 plus 65.
We'll add.
Yeah, you have to add the accumulation.
X plus this.
So 120 minus 80, 40. Here 120. Here also 120. Answer is
This first one 53.
55 Habib.
55. Huh?
I am like pharmacist, you know, doctor writing.
Yes.
Okay, so let's move. Is that okay? Can I continue next question?
So these two will come on only on P&L and statement of financial position.
Yeah. Can you try to answer this question, please? A very difficult question. Someone will answer, I will not give you one guy.
Number 4.
Sure.
Yes.
If wrong, you will be doing down, okay? Have you been using translator?
Yes.
Amudit, sure, answer.
Yes, sir.
Listen. Mr. Azim.
Number 1, no.
Akid. Very good. So now the chance of you is 33 1/3.
And 3.
For to be successful, he has a chance of 33.33% chance.
Last one also wrong.
Last one wrong?
Yes.
Akid, kneel down. I'm not saying correct and wrong. Mr. Fauji,
I still on number 4.
number 4. And Adil G.
Three or four?
Maybe Anna define you tangible, intangible asset. Start with what?
Touch and none.
Yes. Suleiman Musa.
Answer this.
I know number 4.
Kalas, number 4 is the answer.
Number 4. Huh?
Let's interval 3. Shouldn't be 3. Tangible non-current assets are always recognized in the statement of management. No, intangible also we need to recognize.
No, in financial.
We have to recognize both, Habibi. Not only tangible. They are saying what? Tangible non-current assets are always recognized initially, meaning at the beginning. Intangible assets are always recognized initially in the statement of profit and loss. Nonsense. No, that's not. Answer is 4. Okay, before I go to the question 4, one more thing here. See here. The disclosure. Same like PP. How you will show in your note. Same like PP note. Okay? Now let's move on to the next question.
Number 4.
Who's saying 4? You?
Three, maybe.
3? Maybe. Okay. What about you, Habibi?
3.
Who's it? Winter.
2 or 3?
2 or 3. Yeah, he, Mr. Daud.
I think number 1.
Number 1. And you? 4. Actually, answer is 3. Think about the depreciation. When we discuss the systematic allocation of the cost depreciable amount of the depreciable asset of the asset over its useful economic lifetime. So here they are saying to match the cost of the asset to the related economic benefits generated by the asset. Every time you will gain the economic benefits, you need to match for it. Now, in the previous example, we amortized over 3 years because during that period only we are going to generate good income. 4th year, new competitor will come, we cannot generate any good income. So, answer is
But this number one,
okay.
why it is not?
Okay, why it is not correct? Number one, to show the true value of the intangible non-current assets in the statement of financial. Let's say on the first date of the transaction, you still need to show the true value of the intangible non-current asset, correct?
Yes.
And the amortization we do at the end, but the true value you need to show from the beginning. Clear? Okay, with this chapter is over. Stop the video.